If you drive for Uber, DoorDash, or even just use your personal car to visit clients, you are probably leaving thousands of dollars on the table. But here's the scary part. If you pick the wrong way to track your car expenses this year, the IRS might actually lock you out of the best deduction for the entire life of your vehicle.
It is one of the most common traps for 1099 contractors. People see the price of gas go up and think, I should just deduct my gas and repairs. But that one choice could cost you a fortune over the next few years. We are talking about the mileage versus actual debate, and there's a very specific first-year rule that most people ignore until it is too late.
We're going to break down the math and the rules so you don't get stuck. But first, are you a mileage person or a gas and repairs person? Comment your choice right now and I'll tell you which one usually wins for a 5-year-old Toyota.
Okay, let's get into the mechanics. The IRS gives you two ways to claim your car. The standard mileage rate is a flat amount for every business mile you drive. For 2026, the IRS actually bumped that rate up to 72.5 cents per mile. That covers gas, insurance, depreciation, and repairs all in one number.
And the other way is actual expenses, right? That's where you keep every single receipt for gas, new tires, oil changes, and even your car insurance. I saw a post on Reddit recently from a driver who was panicking. They said, I am low income and claiming my mileage lowers my tax refund significantly. Am I required to add it?
That is a fascinating fear. Some people actually want a smaller deduction because they're afraid of losing the child tax credit or the earned income tax credit if their profit looks too low. But the law says you must report all your business expenses. You don't get to pick and choose to manipulate your income.
So, what's this first year rule you mentioned? That sounds like the part that trips people up.
This is huge. According to IRS publication 463, if you want to use the standard mileage rate for a car, you must choose to use it in the very first year the car is available for business use. If you start with actual expenses in year one, you are stuck with it forever for that specific car. You can never switch back to mileage.
Wow. So, if I buy a car today and deduct my gas and a big repair bill this year, I can never use that 72.5 cent per mile rate as long as I own that car?
Exactly. But if you start with mileage in year one, you can switch back and forth in later years if your situation changes. Starting with mileage keeps your options open.
Let's look at the math, because I think people underestimate how much the mileage rate adds up. Let's say you drive 10,000 business miles in 2026.
At 72.5 cents a mile, that is a $7,250 deduction. Now compare that to someone keeping receipts. Let's say they spent $2,000 on gas, $800 on insurance, and $500 on a set of tires. That is only $3,300.
So the mileage person gets a deduction that's nearly $4,000 higher. That's $4,000 of income they aren't paying taxes on.
Exactly. For most gig workers driving reliable, fuel-efficient cars, mileage is the undisputed champion. The only time actual usually wins is if you're driving a massive truck with terrible gas mileage or you just had a $5,000 engine failure.
But remember, if you choose that engine failure actual deduction in the first year, you lose the 72.5 cent mileage rate for the rest of that car's life.
Right, you have to think long-term. To track this, you'll use Schedule C Part 4. You need a written log of your miles. The IRS does not accept estimates or guesses if you get audited.
Grab your phone, check your odometer, and start a log today.
Just remember, I am an educator, not your CPA or tax advisor. This is general information based on IRS publications, not personalized advice. Tax situations vary. Always consult a qualified tax professional about your specific circumstances before making decisions.